So let's go ahead and take a look. Confidential client information. Now, the general rule is you cannot reveal client information unless the client gives you permission. There is a lot of exceptions to that, and obviously, we'll see that if you've been subpoenaed or under court order, or you're under peer review, or you're under ethics investigations by other CPA organizations, then you may have to go ahead and cough up this information, even if the client has not agreed to it. But under certain circumstances, you will be obligated to go ahead and disclose. But beyond that, you have to go ahead and keep client information, confidential. Now, um, let's say, for instance, as a CPA, you've been working for a company and you've learned some confidential information in the course of your dealing with the client, and along with it, you've also learned some general information about the industry that's just part of industry custom or what have you. Okay, if the CPA ends up going to, say, for instance, a competitor, the CPA is obligated to not reveal or act on the confidential information that they gained from the first employer. Okay, so that's one thing you have to observe. Now, if you just learn general information about a particular industry, or about general information about a typical transaction that occurs in a particular industry, you certainly can act on that information. That there's no problem there. But if it's specific, confidential information specific to the first client, and even you've got to make sure that you keep that private. Okay, so we've already talked about the fact that there are circumstances where a CPA must disclose client information irrespective of whether or not they get permission. But beyond that, you've got to kind of keep your lips sealed. Now, very unfortunately, I feel sorry for this particular guy. Um, I hope that you as a CPA will never do something that's so, I don't know, notable that it lands you squarely in every single ethics textbook across the nation. Okay, and very unfortunately, Scott London, who was a former KPMG partner, did exactly that. So this is the story, and it's really kind of a cautionary tale. Scott London was a audit partner with the Los Angeles office of KPMG, and by all accounts, it seems like he was highly regarded. The guy had been at KPMG for 26 years, and any of us who have worked for the Big Four realize, it can be kind of a tough environment. And for someone to make it 26 years, I mean, he had to be someone special, and he really got to the top of the heap there. He was entrusted with the being partner in charge of several of KPMG's publicly traded clients, and so for 26 years had walked between the lines, had been highly regarded, very competent, and inexplicably, during the Great Recession, he ends up passing along confidential information about a client, one of his publicly traded clients, to a friend of his who was a jeweler. And this jeweler friend, during the Great Recession, had been talking to Scott and said, "Oh, my business is in trouble. No one's buying jewelry during the Great Recession. I think I'm going to have to close up my business and lose it all." And so I don't know why Scott decided at this point to go ahead and pass along this insider information. I mean, he knew better. He had never done it before, but he must have just had a lapse in judgment. And so he passes along the information. The jeweler goes ahead and trades on it. Okay, and we all know that the SEC has very special software that detects aberrations in trading, especially before big announcements. And so they picked up on the fact that the jeweler had a lot of trading going on. Um, Very suspiciously, and so they confront him about it. Well, let me tell you this, I think we all understand this. There is no honor among thieves, right? Because if you think that you're gonna kind of cross the line and you're cohort is going to keep fall on the sword for you, or keep that silent. If it's in it of itself an illegal activity, I think the chances of them, keeping silent is pretty much nil. Okay, because people, unfortunately, when pressure is on and they've done something unethical or illegal, they're going to go ahead and try to save their own skins, and this is exactly what happened. So the juror, is confronted by the FBI. He wears a wire. Okay, because truly, they don't really care that much about the juror. They want to go ahead and make an example out of Scott London, and that is exactly what happens. And the odd thing about this is that, the juror had given London a small amount of cash and a um gold Rolex watch as a thank you present. But London was making like apparently around $900,000 a year, and the guy, um, uh, for that type of income, the cash and the watch were basically, I mean, it was nothing. It was rounding errors basically, compared to this guy's income. So he didn't trade. London himself did not trade on the insider information. So he didn't personally profit, with the exception of those small presents that he got. But that really wasn't his motivation. And I've met a few people who knew Scott London personally, and they said that really he was a really great guy, and they liked him very much. And but the deal is his momentary lapse in judgment cost him dearly, because once he was caught talking about the ski on the wire, then he was arrested, and clearly KPMG fired him, and he was on his own for legal fees. And then he ended up pleading guilty and getting, I believe, initially a 22-month sentence. I think they let him out a little bit early for good behavior, but he went ahead and pled guilty because to save his family a trial, and also to save the embarrassment of hauling out KPMG's clients to testify. And so and the one thing that he has said in other interviews that I've read of his, they said, he says the thing that is worse, other than embarrassing his family and causing the financial hardship to his family, and apparently he had some young children at the time, he said, was the fact that, for 26 years he had built up reputation, he had built up friendships, and, he had built up a world for himself. And I think we all kind of understand that, because, as I can tell you here, as in the Dallas Fort Worth area, we all sort of know each other after a while. People go from, eventually go from company to company, and you either have worked with a whole lot of the CPAs here, even in a large metroplex like the Dallas Fort Worth area, you start to work with a whole bunch of these folks, or you at a minimum know of them. And frankly, if you needed to find out about a CPA in this area, all it would probably take are maybe two, maybe three phone calls, and you can get to someone in this area who knows, something about you, and who all the service providers are, and you work with each other. You've, in many cases, have long relationships with them, and you sort of all grow up with each other. And so, here he had this world of his clients that he had known for decades, his internal colleagues at KPMG, and a lot of other CPAs in town. And in an instant, it had blown up. KPMG, when they fired him, told their employees not to talk to him while the investigation was going on. And then clearly he was cut off from his clients. And so, in one interview, he said, the thing that strikes him the most is how lonely he is, because his world has now disappeared in a heartbeat, and clearly he got stripped of his license, and he will not work as an accountant probably ever again. And he says once in a while he'll be at a restaurant and he'll run into a former client or an old colleague, and it's great catching up and all that, but by and large that world has disappeared, and it's been really difficult from him from that standpoint. And it seems to be a real shame. He seems to be a terrific, a very nice guy, but in one period of his life, made a lapse in judgment, and it had permanent consequences to him. And so if it could happen to him, as what seemed to be an ordinary nice guy, it could happen to any of us. And so we always have to be on our guard. Okay, so let's now talk about whistleblowing. And this is kind of a controversial topic. But first of all, let's think about the premise that CPAs have very specific skill sets that most of the people on the planet do not, right? I mean, and frankly, most of the people on the planet would not want to do what we do for a living, okay, even if they could. Because look, accounting is a difficult topic, and we already see this in college where, you know, uh, a lot of people never make it out of Principles of Accounting 1, right? And let alone that, if they manage to struggle their way into intermediate accounting, many people don't make it through intermediate accounting, right? And because it's really, really difficult. And so it takes a lot of someone who's willing to work really hard and has a systematic mindset and has, the analytical ability to be an accountant. And let's not even start with the tax curriculum. Tax law, it can be mind-numbingly boring when you're trying to learn it. And so not many people have this particular skill set or want to have this skill set. And, CPAs also have not only their analytical skills, they have to have the ability to look at a problem and have the tenacity stick through it and try to figure out what's wrong and how to fix it. For instance, does it ever happen where the underlying accounts all tie up with the GL? Of course not. It never ties up, and so a CPA has to have that mental ability to just dig through things and understand why things aren't tying up and figure out what the problems are and to fix it. Okay, and not that many people have that ability, and they don't have the ability to look at generally at financial statements and see when there's something terribly terribly wrong. If there is financial statement fraud going on at any given point, the CPA is probably the first person to figure it out. And if we see this and we say nothing, how long will it take for a normal layperson to figure out financial statement fraud? Well, maybe a long time or maybe never. And things may have collapsed by that point, or you might have uh, shareholders who are badly damaged, okay, by the collapse of the company, or you might have, like in the case of Enron, a lot of employees who have lost everything, their savings, their retirement, their jobs, everything, okay, and the impact goes even further than that. You're not just impacting those employees who lose their jobs, but you're impacting their families as well, and so there's a widespread impact if financial statement fraud is not caught early and something done about it. So, since we CPAs are the first person to probably spot financial statement or tax fraud far earlier than anybody else, this is my opinion. I think that if you discover something that's material, okay, then I believe that it is your duty to whistleblow to the extent that you can do it based on practice standards. Okay, and so uh, I know that when you're dealing with, say, for instance, tax work, there may be a process. If you find that your your client is, not reporting certain income, there is a process that you need to follow in terms of those types of situations. And same thing also for SEC clients or what have you. But to the extent that you can whistleblow, then I think it is the CPA's obligation to whistleblow, because if we don't do it, then it may never get caught, and there's a whole lot of people that could be badly impacted. And also, let's look at Dodd-Frank. Dodd-Frank also seems to indicate that even if you or an external auditor, under certain circumstances, you may have the obligation to whistleblow. If you look at the SEC website, they go ahead and put out they've got a little link where if you are wondering about whistleblowing and if you need to whistleblow under particular circumstances, they go ahead and address that for you. So you do have resources to look at. All right, so and I've gone ahead and put that little link there from the SEC. Now, the thing is, I don't say this lightly in terms of your duty to whistleblow because honestly, it comes at a very, very big price in some cases. And as I've taught CPAs across the nation at this point, I have CPAs coming up to me every so often saying, I have to tell you a story. I found that there was something going on in my company. I tried to report it up the line, and the problem is if you have criminals within your organization basically who are wanting to commit fraud, and you try to call them out. Well, the problem is they're not going to adhere to any type of gentleman's agreement. It could be that if they see you as a threat, that they may try to retaliate. And whistleblowers, by and large, have a pretty tough life. I'll be honest with you. If you look at the whistleblowers such as Cynthia Cooper from WorldCom, or you know, Sharon Watkins from Enron, you know, I think that those ladies showed a tremendous moral courage in coming forward to blow the whistle. But life has not been easy from the standpoint that neither of them have probably worked in their chosen fields since blowing the whistle. And companies are, for whatever reason, reluctant to hire whistleblowers, and that in of itself is, I kind of think is a little bit of a rotten deal. And I don't not exactly sure why, but some of it has to do with, maybe they've got something going on and they don't want the whistleblower to catch them, or there's just too much distraction with that in their past, or what have you. So there is a cost to being a whistleblower. I won't deny that. But as a CPA, and because of your specialized knowledge, and because the public and investors and your other stakeholders depend on you, you may have that duty if it is material, and if you are able to do it insofar as practice standards allows. Okay, so we're coming down to the end of today's seminar, but let me go ahead and finish this up with the case of the killer surgeon. And this is a remarkable story, and I do have a point to putting it in. So about 3 or 4 years ago, the D magazine went ahead and published a long article about the story, and this journalist had spent years trying to go ahead and doing research on this, and it ended up kind of playing itself out here in the Dallas-Fort Worth area in a very dramatic way. So this is the story. In around, I believe 2007 or so, there was a doctors group in a Tony part of North Texas that said, "Hey, we want to go ahead and perform more back surgeries because these surgeries are quite lucrative, and we need to hire another surgeon to increase the number of back surgeries that our group does." And let me say from the outside, back surgery is a very specialized field. There's not that many people who do it. It's very dangerous. Okay, so even if everything goes as well as it can go in the course of a surgery, there is a possibility that the patient could be in worse shape after the surgery than before, because it's a delicate surgery and it's highly risky. The other thing too is that patients sometimes are in really terrible condition when they do back surgery. Because they're in a tremendous amount of pain, and they're willing to put up with the pain for a long time until it's basically the surgery is their last resort because of the tremendous risk involved. So sometimes patients, as I said, are in worse shape, or sometimes they die. So this is not an unusual situation to occur. So with that backdrop, the doctors group hires this surgeon out of Ohio, and when they do a background check, there's no black marks by his name. Interestingly, in this story, they call the doctor's one of his past supervisors, and this doctor that they're trying to hire, his name is Christopher Dunst, and so they call Dr. Dunst's former supervisor or colleague and want to know some more information about him. Well, the colleague actually knew that Dr. Dunst was kind of a mess, and probably was not a great hire. But that particular individual decided to stay silent because he didn't want to get in trouble with a libel suit, and he didn't want to start a fight. So he just stayed silent, even though he knew that Dr. Dunst was highly questionable. Okay, so the reporter goes ahead and reveals the fact that Dr. Dunst accepts the offer, moves down to the Dallas-Fort Worth area, and immediately acquires a girlfriend. Okay, and according to this journalist, the girlfriend was a dancer and entertainer by profession, and so the girlfriend was interviewed for the article, and she revealed that Dr. Dunst often would drink alcohol and take cocaine and not get any sleep all night long. And then, by 5:30, 6 o'clock in the morning, he's all scrubbed up and ready for surgery. And so, which is just absolutely shocking. And so, there was an anesthesiologist who was assigned to Dr. Dunst for his first set of surgeries when he got to Dallas. And on the very first surgery, the anesthesiologist was observing and saw that Dunst was just messing it up. He was messing up the surgery very badly, just botching it. And the anesthesiologist was so incensed that he uh, immediately canceled all of his future surgeries with Dr. Dunn's, and called the medical board and said, "You've got to yank this guy's license. I mean, he is really screwing it up." But for whatever reason, the licensing board did not act, and so the anesthesiologist tried to call the hospital, say, "Pull this guy's privileges. He's really harming a lot of patients." But of course, the hospitals were slow to do that because they were making a lot of money off the surgeries, and also they didn't want to, I guess, act like they knew that he was. I guess there was a liability issue if they went ahead and yanked his privileges. It's like that they knew that he was a rotten surgeon, and it could cause greater legal liability for them should they get sued, and so on and so forth. So Dr. Dunst was not getting stopped by these particular mechanisms, and add to that. The fact that his malpractice insurer was settling out now with some of his patients. And look, I am not going to pass judgment here. If I understand why these patients would have settled out with the doctor on his malpractice insurer, because some of the patients who died as a result of his horrible surgery technique, I get that, the families have bills to pay, and their loved one is dead, and so they've got to find a way of being able to still live, or if you're one of his patients who was in worse shape after the surgery than before because of the botched surgery. I get that, individual might have been in tremendous pain, couldn't work, and of course has bills to pay as well. And so I totally get why they may have settled out. But the problem is when you settle out a civil claim, the problem that you have is the other party can, of course, require you to sign. We all know what this is, a non-disclosure agreement. In other words, you have to keep it confidential. And the rub here is if the first set of patients settled out, then the problem that you're going to have is when the first group settles out, then they stay silent. Well, Dr. Dunst is free again to go on to the next patient because they don't know that this guy's really a disaster, and so on and so forth. So the silence of the earlier patients potentially led to more patients being harmed. Okay, especially since the regular mechanisms of the medical board and other hospitals pulling his privilege had not been working. Okay, those safeguards had failed. So this was all going on. The patients of Dallas are obviously in peril at this juncture, okay, because of this guy. And the way the whole situation finally stopped was that the anesthesiologist finally found an assistant district attorney in Dallas who was willing to go ahead and investigate further. They exhumed a couple of Dr. Dunn's former patients, and they were able to establish that Dr. Dunn's grossly negligent behavior led to essentially these homicides, and so he was charged criminally. Now, the one thing about having a criminal action is there's no such thing as a non-disclosure agreement. It is out there, and so that's how things broke open. And so then, after trial and everything like that, Dr. Dunst was convicted of several grossly negligent homicides, and he ended up essentially getting a life sentence. In fact, he was sentenced actually just a few months ago here in the North Texas area. And so it was really hit the news big time. Now, why do I bring this up? There's a difference here. What happens if you're a CPA and you find out about something really terrible going on, okay, and you bring it up to management and they say, okay, you've got two choices. You can either take this giant severance payment, quietly go away, and then go on with your life, but you have got to stay silent, or if you speak and you go ahead and blow the whistle, we are going to sue you. We're going to muddy your name. We are going to get you blackballed. And so here are your choices. Okay. The problem is if you stay silent in that particular scenario, it could be that the fraud gets perpetuated and more people get hurt. If you speak up, in the second scenario, you may go ahead and stop the fraud, but there's no honor among the. Well, let me just put that. They're a bunch of criminals, right? And they're not going to go ahead and treat you with kid gloves. So what do you do in this particular case? This is what I'll leave you with. A CPA in that particular situation may not be free to settle out in their own best interest. okay, because they have to think about the public. And so a CPA, based on your public duty, may have the obligation to speak out. And that is the difference between us and normal people, is that we're not always free to do things that are in our own best interest. We may have to consider the public before our own our own benefits, for that very reason, because we have signed up for this as certified public accountants.